Welcome back to the Deep Dive.
Great to be here.
Today, we're plunging into a whole stack of insights, mainly from the Wall Street Journal's weekend edition. That's July 19, 2025.
Right.
And our mission really is to cut through the noise, find those key nuggets, those aha moments for you. So you walk away informed, but not, totally overwhelmed.
Absolutely. We'll start with a key research piece, the economic outlook, then hit the markets, some corporate news, broader economic trends, geopolitics too, and we'll wrap it all up with a few questions to tie things together.
Sounds good. Okay, let's kick things off with the economy. That's always front and center. The Journal's quarterly survey of economists. It just landed.
It did, conducted between July 3rd and 8th.
Okay, and the headline. What's the big takeaway on recession risk, GDP?
Well, the consensus is actually pretty interesting. They're seeing a reduced chance of recession.
Okay.
And stronger GDP growth for the second quarter than maybe previously thought.
So, a bit more optimistic there.
A bit, yeah. Now, drilling down on President Trump's tariff plans, for instance.
Yeah, always a hot topic.
Economists are forecasting a pretty modest reduction, actually, like 0.1 to 0.7 percentage points off the year-over-year CPI in Q4 2025.
Modest. That's less impact than some might expect, right?
Exactly. Suggests the direct hit on overall consumer prices, inflation, might be relatively contained, according to this group.
Interesting. Okay, what about immigration, its economic effect?
Well, assuming policies stay as they are now, the projection is generally no change or maybe a slight increase to annual GDP growth, up to maybe 0.5%.
So again, maybe not the huge drag some narratives suggest, at least in this forecast.
Seems that way. And on the Fed, this is key. Will Trump's preferences influence interest rates under the next chair?
Yeah, what do they think?
A big majority, 2/3, 66.7% believe no effect.
Really? So they see the Fed maintaining its independence?
That seems to be the view reflected in the survey, yeah. Emphasizing that perceived independence.
Okay, interesting baseline. So with that economic outlook, how did the markets actually behave last week? Did they buy into this reduced recession risk?
Well, we saw the S&P 500 gain 0.6%, NASDAQ jumped 1.5%, both grinding out new highs.
So aligns with the growth story?
It does, but interestingly, the Dow Jones, it edged 0.1% lower.
Huh. Little divergence there. What do you make of that?
Could hint at a bit of a shift, maybe? Investors perhaps leaning more into growth in tech, a little less towards the traditional industrial giants in the Dow. Just a slight signal, maybe?
Right. Beyond the indices, some big corporate stories broke. Chevron getting the green light for its Hess purchase. That's huge.
Yeah, $53 billion. An arbitration panel basically dismissed Exxon's claim.
So that clears the path.
It does, and it really highlights the intense competition for energy assets, those long-term plays.
And on the other side, Reckitt Benckiser selling off a chunk of its business.
Right, their home care division. That includes Airwick, Sillet Bang, names you'd recognize. They're selling a majority stake to Advent International.
So how much?
Deal values the unit up to $4.8 billion. Reckitt keeps about 30%.
What's the strategy there, you think?
Looks like classic portfolio streamlining. Shedding a non-core asset lets them focus on their, more profitable health and hygiene stuff. Maximize value.
Makes sense. And speaking of value, earnings season. We saw some strong reports. Saab, 3M.
Yeah, really strong. Saab shares jumped over 16%. Swedish defense company.
Wow.
Beat earnings, raised their full-year guidance, and notably, driven by missile systems, ground combat weapons.
That tells a story beyond just Saab, doesn't it?
Yeah, absolutely. It's a clear sign of that ongoing global rearmament trend. Increased defense spending reflects the geopolitical tensions we keep seeing.
And 3M.
Also raised its full-year outlook after beating Q2 expectations. Shows resilience in those diversified industrials. Steady demand.
Good signs. What about financials? Amex and Schwab seem to do well.
They did. American Express saw revenue up 9%. And get this, card fees jumped 20%.
20%. People are really chasing those perks then.
Apparently so. Sign of pretty robust spending, at least on premium services. And Charles Schwab, profits boosted by a surge in trading activity.
So volatility helps them.
It certainly can. Their stock's up nearly 30% year-to-date. Suggests active trading, demand for financial services.
Yeah.
It's still strong despite higher rates.
Okay, one thing that really jumped out at me, though, was this long-term trend with small-cap stocks.
The underperformance, yeah, it's quite something.
For over a decade, Russell 2000 gained only, 7.2% annually since early 2014, compared to the S&P 500's 13.2%.
It's a huge gap.
In this stat, NVIDIA alone, at $4.22 trillion, is worth 65% more than the entire Russell 2000 combined.
Just think about that. One company versus 2,000.
It's staggering. So for you, the listener, trying to build a portfolio,
Yeah.
what's the takeaway? Is large cap dominance just the reality now?
It's definitely been the reality. You absolutely have to factor this divergence in. It's not just about picking stocks. It's these big market tides.
Is there an opportunity in small caps then? Maybe.
Well, some analysts argue, yes, that this gap could mean pent-up value, maybe for a longer-term play if there's a market rotation. But for now...
Yeah, the narrative is still very much favoring the big dominant players.
Okay, let's shift gears. Beyond the markets, beyond corporate stuff, broader economic landscape, policy shifts, global affairs. You mentioned healthcare costs earlier.
Right, and the numbers are, well, eyebrow-raising. We're seeing insurers asking for hefty rate hikes for 2026 on the ACA marketplaces.
How hefty?
Blue Cross Blue Shield of Illinois, asking for 27%, Texas 21%. The median request is around 15%.
Wow, 15, 20, nearly 30%. Why?
They're citing higher healthcare costs generally, plus changes in federal policy, like subsidy cuts.
So for a family trying to budget, that's...
But directly, less money for other things.
And sticking with household finances, housing affordability, there's a new bill.
Yeah, interesting proposal. 2 congressmen pushing a bill for a government-backed loan program specifically for accessory dwelling units, ADUs. The granny flats, backyard cottages.
That's them, usually small, 600 to 1,200 square feet. The idea is to tackle the housing shortage by making it easier to build these on existing lots. Add density.
An attempt to chip away at the supply problem.
Precisely.
Okay, let's pivot to defense, geopolitics.
Yeah.
Lots happening with Russia, Ukraine, NATO. What stood out from the sources?
A few key things showing, I think, increased Western resolve. First, the Trump administration prioritizing Germany over Switzerland for the next batch of Patriot missile systems off the production line.
Why Germany?
Well, the stated goal is to let Berlin then send 2 Patriots they already have to Ukraine. Fits Trump's emphasis on NATO allies contributing more, sort of backfilling their stocks.
Got it. And the EU?
Agreed on its toughest sanctions package against Russia since the invasion began. They're blocking attempts to revive the Nord Stream gas pipelines.
Closing that door firmly?
Seems like it. And lowering the price cap for Russian oil sales to $47.60 a barrel, trying to squeeze those revenues.
And the UK chimed in too.
Yeah, they named 18 alleged Russian spies, sanctioned 3 military intelligence units for destabilizing campaigns across Europe. They noted Russian attacks in Europe nearly tripled between 2023 and 2024.
So a coordinated pushback on multiple fronts: military aid, economic sanctions, counterintelligence.
That's the picture, yes.
Yeah.
Deepening pressure.
Okay, shifting back home. A few significant domestic policy and legal developments. Illinois pensions. Sounds like trouble.
Potentially huge trouble. There's a bill that sweetens pensions for Chicago police and fire hired after 2010. If signed, it could add over $100 billion in new costs for taxpayers.
$100 billion? How?
City actuaries are projecting this bill alone would drop the funding level for those plans to an abysmal 18%.
18% funded. That's critically low. Healthy plans aim for what, 80%?
Exactly. 18% means a massive hole that taxpayers will eventually have to fill. Think major tax hikes or service cuts down the line.
Yikes. Okay, what else? The Justice Department and antitrust.
This was interesting. In a lawsuit involving anti-vaccine activists versus media companies, the DOJ endorsed the argument that the Sherman Antitrust Act,
Which is usually about preventing monopolies. Right.
right, that it could protect competition and viewpoint diversity, even if those viewpoints involve false statements about vaccines.
Huh. So potentially broadening the scope of antitrust law into the realm of information.
It's a novel argument, certainly. Could have significant implications if it gains traction.
And finally, Wisconsin. DEI programs.
The State Bar Association settled a federal lawsuit. They agreed to end the use of DEI criteria in race-based leadership programs, specifically removing race, gender, or other immutable characteristics from applications.
Part of that broader legal pushback against DEI initiatives we've seen elsewhere.
Exactly. Reflects that ongoing legal and political debate.
Okay, that is a lot of ground we've covered. So, to wrap this deep dive up, let's try and connect some dots with 3 key questions. Pull these threads together for you, our listener. First up, we have economists seeing decent growth, less recession risk.
Yeah.
But at the same time, these huge potential hikes in ACA premiums. What does that combination signal for consumers? For their spending power?
Yeah, it signals a really complex, almost contradictory environment, doesn't it? The big picture, the GDP numbers might look okay, maybe even strong, but for millions of households facing sharply higher healthcare costs, that directly eats into their budgets.
So less money for other things.
Right. It suggests that individual consumer confidence, and especially the ability to spend on discretionary items, non-essentials, could really face some headwinds. So GDP might grow, but it could feel quite different on the ground for many people. Makes it tricky for consumer-facing businesses.
A very nuanced picture indeed. Okay, second question. We talked about the tech sector, the intense bidding war for AI talent, YouTube making big inroads into TV viewing. How do these dynamics reshape the investment landscape for the big guys and the startups?
Well, the AI talent war, with offers reportedly in the hundreds of millions, it just underscores the immense, almost unbelievable value being placed on AI innovation right now.
It's where the future is perceived to be.
Absolutely. So for investors, you'd be looking at companies aggressively grabbing that top talent, sure, but also those effectively using AI to disrupt products and services across any sector, really.
And YouTube moving onto the TV screen.
That signals a major strategic shift away from just traditional media models. It suggests future growth lies with platforms that can successfully bridge that gap, bringing digital content, maybe sports rights, tailored experiences right into the living room.
So investing in content delivery, aggregation.
Could be a key area, yeah. How content reaches viewers is being fundamentally reshaped.
Okay, final question. Thinking globally again. The U.S. speeding up Patriot missile deliveries. The EU tightening sanctions on Russia. What are the longer-term ripple effects here for defense spending for energy markets?
The defense side seems pretty clear. This coordinated Western support for Ukraine, especially the U.S. strategy of backfilling allies so they can send their own gear, it signals sustained high demand for advanced defense tech.
Good news for defense contractors, presumably.
For years to come, potentially. It points to a prolonged period of elevated defense budgets globally. On the energy side, the EU's tougher sanctions, blocking Nord Stream, pushing the oil price cap lower, it indicates a long-term strategy to really cripple Russia's energy revenues. This isn't just a short-term blip. It means ongoing volatility, probably, and a fundamental reshaping of global energy trade flows. Who buys from whom, the routes, the security, it's all shifting.
A fundamental reordering, as you said. Okay, well, that brings us to the end of this deep dive. We hope distilling these key points from the journal and other sources has given you some valuable perspective.
Yeah, hopefully some clarity on how these different pieces, economic forecasts, market moves, policy shifts, global tensions, all connect and influence each other.
Definitely food for thought. We encourage you to reflect on how these interconnected events might shape things going forward.
Always more to learn, always more dots to connect.
Thank you for joining us. We look forward to our next deep dive.